All right, all right. What's going on, everybody? Billionaire Pete, good to see you. Robert Dodd, always a pleasure. Always a pleasure. And then Fred, I don't know if we met before, Fred, but if we haven't, hopefully we can meet sometime soon. But thanks for being here and good to see you tonight. We got a special Zoom, everyone. We drop these into our Freedom Chasers cadence every now and then just to mix it up a little bit. And, we like to throw it in on Thursday, bring in another topic that is a little bit more outside the box from our traditional highway that we're driving on in the multifamily space. But we like to bring in an element of diversity every now and then. We think that's important just to mix it up again. And who knows, it may scratch an itch that somebody's extremely curious in. And I'm particularly looking forward to tonight. We got a couple of special guests talking about, I think that's something extremely important, especially in these economic times that we're in. We're talking about diversifying your investments, maximizing your returns, and minimizing your risk, what that looks like. And we have two amazing guests tonight. So, Paul, I think without further ado, let's go ahead and bring you up since you're going to be really the main star of the show here. So how about you give us a little bit introduction? I know probably most people tonight, haven't met you in person. Maybe they know a little bit about you, but probably not that much. So who is Dr. Paul Cink?
Hey, Trevor, how you doing? I'm just a regular guy, but great to see everybody else here tonight. Looks like we got a small but appreciative crowd, so that's great. And we can maybe make it kind of more intimate tonight and ask a lot of questions and things. So yeah, I mean, people kind of ask me a lot of times, how did I get into real estate and how all that happened? Well, in my other life, I was a surgeon, a head and neck surgeon for the last 30 years. I just retired about a year and a half ago. But somewhere along the line between maybe it was I was sleepless call nights or something, and I was thinking that I should really probably help diversify myself. I should and my family, and I should be looking at other income streams and just looking at other ways of looking at business and all that. So about 20 years ago, we started a family real estate company. We started small and we started buying some lake lots around our lake house, and those went well for a couple of years. And then I actually literally went and remodeled a little lake house place on the weekends with a friend of mine, and hammered nails and did everything, put up drywall and got all of that experience and sold that property, and that went really well. Then I bought a small multifamily, little 16-unit multifamily, and bought some rental houses and did that sort of thing. So kind of slowly got into all that. And then my wife was helping me, and my children were actually helping as well. And so I think the point there is that you can start small, and you can start while you're already in a W-2, and even a W-2 where, I had quite a few hours a week. I had call nights and all that sort of thing. I operated about every day. And so, but still able to do that. And so a lot of people ask me how that'll happen. And I think it's just a kind of a gut feeling that I had that I needed to do something else to kind of solidify my future. So that's Absolutely. And so that's been great. And so that's turned into another, so I ran into another guy, and we actually started a development company also on the side about 13 years ago. And that development company actually turned into at our total there for about the 13 years, we've done about $500 million in assets, in multifamily assets, office, industrial, those kind of things. And it just kind of kept snowballing a little bit. We've done about 45 complete cycle syndications. Right now with that company, we have a little over 1,100, a little over 1,000 apartment units under construction right now.
Outstanding.
So it just grows, and I think that's a hopefully lesson to everybody, that's something that that you can do even while you're still in a W-2. So that's a little bit about me. We still have our family company. We're now more focused in Texas. My adult children are actually with me in our company, and we are working with Massive Capital, Michael Bailey and Schreier and Sanjay, and doing projects with them. So
outstanding, outstanding.
Yeah,
it's a real honor to share the room with you, Paul. Obviously, that's an extensive resume, right? I mean, you serve the medical profession at a high level for a lot. I just have a huge amount of respect for people that cut other people open. And sorry if that's just a low level way of putting it, but at the end of the day, it's something extremely important that we all need. And then plus your vast array of real estate experience, from just something small to then huge developments, and now multifamily syndication, and now massive capital and things like that. So it's just really great that we can have your wealth of experience and you kind of really driving the ship here to speak to our special topic of tonight, which is diversifying your investments in this economic time. So that's actually probably a great transition, Paul. For I'll stop my screen share. I know you have some slides to share as well. And so feel free to grab that screen share and start firing away.
All right. Let me get to this. All right. So here is our diversified project that we're going to be talking about. But before I get into all of this, I think I want to just say a couple of words about diversification. So you all are in different kinds of real estate probably. And a lot of you, I'm sure, are kind of focusing on multifamily. That's kind of the hot asset class at this time, and has been for the last 10 years. And it's been great. And so we don't know where it's all going to go with our economic times, our interest rates, and all that sort of thing. It's been a little bit of a challenge this last couple of years, and we don't know where it's all going to go. But still, it's a great asset class. Multifamily has done well in the previous recessions, and that's all great. But you should all still kind of look at other things, other diversification. So, you should diversify your real estate portfolio just like you diversify your stock portfolio and your securities. It's really the same principles apply. So why do we diversify? So diversification of real estate assets is done to mitigate risks in your portfolio and to ensure ongoing and steady growth. So, we don't know what's going to happen in the future, right? We don't have a crystal ball. But based on historical data, we do know that corrections and recessions happen in cycles. So we've got to pay attention to the business cycles and economic cycles. So with that, if we are not in a recession currently, we do know that a recession undoubtedly will be in our future at some time. And we've got to be kind of prepared for that. And if we are currently in a recession, we undoubtedly know that a recovery will be in our future at some point in time, and we have to prepare for that. So we typically talk about projects that are popular and that are working well in our current business cycle. But we thought it's really important for you to also think about those assets that fit into your long-term portfolio also. Again, diversification is one of those most powerful strategies you can do to maximize your long-term growth of your portfolio. It lowers your overall risk. It increases your chances of the higher long-term returns. So I do want to just briefly talk about 5 different ways that you can diversify your portfolio.
Outstanding. Outstanding.
Go ahead.
A quick question here, Paul. I really like how you framed it here. There's if you're approaching a recession, okay, cool. You need to understand that, right? And I'm assuming in a recession environment context, probably some investments are going to be better than other investments, right? And then obviously, if you're in a recession, at some point, you're going to come out of that recession. And all the points, and I'm just kind of making an educated guess here about what you're saying. And so let me know if I'm misaiming here, but you have your curves of up and down in the market, right? And probably investments are going to be better depending on where you're at in that curve, right? If you're at the bottom, you're going to want to focus on these type of investments. If you're the top, these type of investments, and anywhere in between. it's probably good to understand the spectrum of different investment types, so you know you can be super strategic where the market is at.
Absolutely. So as an example, with my development company this last year, we were on hold. We were not buying properties. Interest rates were rising. We didn't know where it was going to go. We couldn't project cap rates. And so where are cap rates going to be in 6 months? Who knows, right? Nobody knows.
Yep.
So
Yep.
where are the values? So, however, there are some people who are still trickling along, buying up properties because they were kind of on the other edge of the curve. So suddenly our company became sellers. You know, we had some nice projects, but somebody's going to come along and buy our property or give us an offer that we can't refuse. And so we
For sure.
sold a bunch of properties in 22, and now we're sitting on cash. And so
Okay.
we're waiting for, you know, the recession to come through maybe this fall and into next year. We'll see what interest rates do, but we're going to sit on cash for a little bit. And then there's going to be some opportunities that really pop out. So
Outstanding.
great. So you can diversify your portfolio. I just kind of put it in like 5 different ways. So by asset type, right? So you've got single family homes, multifamily, retail, industrial, office, storage, and even in storage, there's self-storage, there's industrial storage. And tonight we're going to talk about flexible storage. You can also diversify by geographic location, right? So real estate is very hyper local. One community might be booming, another community might be slowing down. So we look for markets all over the country that are high job growth, good population growth, wage growth, job diversity, and a strong overall growth in that market or in the sub-market of that market.
Okay.
Right now, we are looking at, you know, Austin is pretty hot, but Austin is, the prices are pretty high. But the sub-markets around Austin, Round Rock, Georgetown, Leander, Kyle, Buda, San Marcos, they're hot, they're doing well. And so, you know, you probably needed to be in those sub-markets maybe about a year ago, and we did get into some of those. And now, depending on the cycle here, we're going to start developing townhomes, and hopefully we'll be on the other side of the recession for those.
Beautiful.
You can diversify also by asset class. We all know class A, B, and C, depending on the business cycle and the economic situation. So if we're in a recession, some of those A tenants might go down to a B property. Some of the B tenants might go down to a C property. So again, how do you buy those in different economic cycles? Got to be aware of that.
So Paul, would you recommend in a recession, you know, basically being super averse to, you know, going after A-class multifamily properties or investing in A-class? I mean, is that would be kind of a good rule of thumb to abide by?
That'd be a great rule of thumb. Yep.
Okay. Good to know.
But you might be able to pick up a C property that you might not have done in the past, hold it for a couple of years and improve it and sell that. Another way you can diversify is by strategy and hold time. So you can buy and hold. That's obviously a good strategy. And I know some people who never sell their properties. They've got the strategy. I'm going to buy, I'm going to hold it forever. And then I'm going to buy another one, hold that. And that's fine. That's a good strategy. However, I do think you need to play the business cycle. And then there's the BRRRR method, right? Buy, build, build, rehab, refinance, and repeat, right? And you can do all that kind of thing. And you can do that even in the same geographical market. So the hold time can be short, it can be long, or it can even be generational. Depends on what your needs are and how you want to do that. And again, I told you that we typically hold our properties about 5 years, you know, and that's where it kind of seems to fall into that business cycle type of thing. However, this last year, people were knocking on our doors, want to buy your property for this price. Okay, we sell, you know, and so now, like I said, we're sitting on some cash. And lastly, you can.
Paul, well, what's the secret sauce behind 5 years? Because you hear that number kind of thrown out quite a bit. It's either 5 or 10, it seems like, right? So what's this multiple of 5 thing?
So there's two reasons, right? So what is the recession cycle average? I can't quote it off the top of my head, but probably every 3 to 5 years, we're going to have some kind of a correction, some kind of situation. The other
Okay.
factor is most investors don't want to tie up their money for more than 5 years.
That's a good point.
And so there are some 2-year properties out there, 3-year, and I think investors are more appeals to them more.
Okay, very good. Thank you.
Last way you can diversify your properties, your portfolio is by either active investing or passive investing, right? So active investing, you've got your own business strategy. I mean, you manage it yourself, you do all that, you learn all that, you become a GP. And then there's passive investing where you're an LP. That's where the syndication strategy that we're all familiar with is, and you get a third party property manager. So in summary, think of diversification as minimizing your risk and also maximizing your steady long-term growth. So we're all in this, for a long time, probably. Real estate is cool because you can do it until you're 100, right?
That's right.
I have to tell you, we have 2 investors, they're brothers. One is 95 and one is 93, and they're investing in like 30-year projects. And
Like right now they are?
Oh,
like
yeah.
In their 90s, they're investing
In their
30-year
90s,
projects.
yes. And obviously they're not investing for themselves. They're investing for their families. They're not even their kids anymore, but in their grandkids. And that's the generational growth I was talking about.
I love that.
So want to ask you all to step out of your comfort zone tonight, try a different kind of investment, think about that. And we think that this will strengthen your overall growth of your portfolio for the long term. And
Very
so
good.
I want to talk about a diversified project here tonight. And if you're ready for that, Trevor, I'll proceed, or do you have anything else? Any other
No,
questions?
sir. No, sir. Let's fire away. Thank you.
So, there's all kinds of alternative investments or diversified investments. You can invest in car washes, you can invest in ATMs, you can invest in a lot of things, obviously invest in stocks and all of that as well. But within real estate, as we've talked about, there are many different ways to diversify your portfolio. This is an interesting project, an interesting concept that we have come across, and I've known these owners for about 4 or 5 years. And this is what we call a storage condo or functional storage or flexible space, and it actually is called X space. So you can see this design here. This is our design for the Houston project. So how this all came about, let's see, maybe I'll scroll here a little bit. And just to give you a little flavor, this is, I like this slide because it's a cutaway of the X space. And you can see this is a 4-story, and you can see people driving in the first floor level here. Up on the second level, you can see there's a hallway in the middle, and then storage units on either side. You can see on the right lower side here, people standing, and then there's a car and a motorcycle, and then there's a mezzanine, and then somebody standing on top. So these are 20-foot from floor to ceiling, and mezzanine in the middle of mezzanine there that can obviously increase your space, and you can use it for all kinds of things. And so second floor, third floor, fourth floor, and you can see the mezzanines again, and the people parking their cars and that sort of thing. So this is kind of the concept. I do want to say with our disclaimer that I'm not an attorney, thank goodness, and I'm not an accountant and all that sort of thing. So, but so we ask you to consult your professionals before you would ever invest. This is X space at night. But this is kind of the heart of it right here. So this concept was started in Australia by a family real estate company, and they were building self-storage, kind of traditional. And so in the what they were very good at listening to their tenants, and the tenants were asking them, can you make my space a little bigger? I not only want to store stuff there, but I want to do stuff there. So they started making these facilities a little bigger in their units. And what happens when somebody has a bigger unit? They start to do stuff in there. Maybe they start some hobbies in there. Maybe they're doing pottery or art or something like that. And then all of a sudden somebody puts a TV in there, and they put a couch and a chair, and they say, hey guys, come on over and watch the game on Saturday in my storage space. And so what happened is they listened to their tenants, and they built bigger units, and they called them flex space. And so in Australia, they were called flex space, and it went over so well. They built a bunch of facilities in Australia, and now those owners brought that concept to the United States, and they built their first X space in Austin, and that's gone extremely well. And this second facility is now going to be in Houston.
Paul, when did the one in Austin launch?
It launched last year. It took them a little time to build. Now, of course, they got into the pandemic and the COVID era with low logistics and materials and all that sort of thing. So it took them a few months longer to build than they thought. But again, it had to go through COVID to do that. But COVID brought on another interesting concept, and that is, as you know, people got out of their traditional offices, traditional business offices. They were working from home, and so working from home, less commute time, less pollution, all that sort of thing. Great, but now they're at home. So what am I going to do at home? Now I'm here at my home 24/7. I eat here, sleep here, work here. Now, what else can I do? So it was kind of a marriage between home office and the traditional standard office, and people are getting out and loving these flex spaces that they can use as office or storage or whatever they want.
I love that. Just so everybody knows, before we fired up the Zoom, Paul and I were talking about the craziness in our homes, him with the dogs, looking after some dogs, and my kids going absolutely bonkers because it's that time of day. I'll tell you what, Paul, it would have been nice to have been able to escape to one of these guys to have this Zoom tonight for me, honestly.
That's right, right? That'd be great, yeah. So, yeah, I apologize. I have my son's dog in the background, and he just fell asleep, so we'll keep our fingers crossed.
There we go.
So this is the team that we've assembled for this concept, and it is a combination of X Space owners, PSC Properties, and Massive Capital. And so here's the team, the X Space team. Byron Smith was the Australian whose family built all the flex spaces in Australia, and they have done a great job there, and it brought the concept here. Howard Ecker is a fairly famous business entrepreneur in Chicago, and he has a tremendous experience in his businesses and offices, and he's on the chairman of the board of X Space. And Lyle has a lot of experience in planning, development, construction, and all of that. And so it's great to have him on board as well. So that's
amazing. Fun fact here, Paul. Actually, Lyle and I played together for 1 year at UT.
No kidding, really? So
sure did.
Yes.
Sure did. Yeah, I wish we had overlapped more, but he's just a little bit older than me. But an absolutely outstanding player. Obviously, he had a great career in the NFL, hook 'em horns. But great to see his picture up here doing cool stuff.
Yeah, that's great. Awesome. I'll tell him I saw you. This is our team, PSC Properties, and I work with my son and my daughter. And all of these slides were produced by my daughter. She's a master's in graphic design, web design, bachelor's in journalism. So she does a lot of this copy, and she's phenomenal at that. Ryan does a lot of our asset management and our other relations, marketing relations, some property management as well. I just want to point out that these three properties over here that PSC owns, this Villages of Fade is a mixed use. That's another diversification, right? We have retail on the bottom, residential on top. We own medical office buildings, and here's one of them, an emergency room in Mesquite by Dallas. And then on the bottom here, with massive capital, we are planning and doing the design of 110 townhomes in Georgetown, just right outside of Austin. So that's our rendering of that. And then the massive capital team, phenomenal team. Sanjay, Schreier, and Mike are the principals, and they've got a great team here on the right. I think Maria's on the call. Hey, Maria, how you doing? And these guys have put together a phenomenal team, and they have great experience. They're all engineers. They're all petroleum engineers, and they really like decimal points. So they put these
Yep, I can relate to that.
financials down to the penny. So it's been phenomenal working with them over the last year, and look forward to many more properties with them. And so here's a little bit about the space. This is the rendering of the lounge up on fourth floor. And again, just a little blurb about what the space is. It's very flexible. There are two words that come to mind is flexibility and control. So you can control your own space, and you can do anything you want in there as long as it's legal. And you can have an office, you can have a lot of things there. You can store your mother's antiques if you wanted to. And they all open to the inside on the hallway. And again, it creates a community atmosphere where you get to know your neighbors and that sort of thing. One more thing about the design of X Space Houston is by a fairly famous designer out of Mexico, Francisco Gonzalez Pulido. And these are some of his other projects. He's designed this beautiful baseball park in Mexico City. He's designed these towers, the Veer Towers in Las Vegas, and he's designed the Bangkok airport. And he's got many other ones that he has done around the world. And the other thing that he designed is X Space Houston. So he put together this exterior and function on the inside, and it is 4 stories. This grid up here on the 4th floor is a lounge. And we just think it's a very beautiful facility. We love the lights. We love the functionality of it. And it really looks well. We think the design has been superb.
Paul, are those white panels, are they just aesthetics, or do they serve also some sort of functionality, besides looking cool?
They look cool. There is some kind of functionality there. I don't know if it's a hedge against hurricanes in Houston, or I don't know, but I think it, I don't know that it has any other significant functionality to it, but it really does look cool. So,
and then the 4th floor there, is that open to the outside, or is that glass?
Yeah, there's screens there, and I think sliding glass doors, so you can encapsulate that lounge. And here's the lounge up here, and here's the stores, the levels, and the rooftop and the interior. What I wanted to really show you here was actual spaces, actual pictures from X Space Austin. So these are actual units that we took pictures of here a few weeks ago, and you can see what people are doing in their units. On the lower left there, this guy's got a pool table, and he's got a lounge and obviously big screen TV, obviously primed for a Monday night football game or whatever he chooses. On the lower right, somebody's using this more like an office, and you can see the chairs, office chairs, and that sort of thing there. Upper right, you can see the mezzanine stairs going up to the mezzanine, and this person is a reader. He got a lot of books and a nice comfortable chair. Sit there on a Sunday afternoon, and just the other deckings that people do of their space. Unfortunately, my wife and my daughter got a hold of an interior designer to outfit our space. So I don't know how that's going to turn out, but we'll see how that goes.
So Paul, do people typically drive their car right in front of their unit and then just get out and go in, or how does that work?
So originally the concept was for people to park inside their unit. And what they found out was that the tenants started using the entire space of their unit. Now, you could leave a space open for your car and obviously park inside their unit. But what they're finding in Austin is people are parking just outside their unit and using the full space of the unit itself. And you can
Okay.
see here in the middle, that is a garage door, and the garage doors on the third level are all see-through, they're glass, so you can see through. Now, some people will frost those couple of lower panels. For some reason, we've kept ours kind of open. And but the nice thing, and the other fun thing that's happened with this space is that I'm meeting all of my neighbors. So down the hallway from me is a guy that buys and sells fish all over the world. He travels to Thailand and Vietnam every couple of months, and he's buying and selling fish, and says stop by and pick up some salmon in my freezer. And I've gotten to know him. He's a really great guy. Another person down the hallway has a cold storage real estate company, and they'd use that as their office in X space. Another person bought their unit and rented it out. And when they rented it out, they're renting it out to a company that is building drones. And so it's cool to go down and talk to those guys and things. So it really creates a community atmosphere. And, every now and then we all meet up at the lounge and might have an adult beverage and look out over Lake Austin or Lake Travis. And it really creates a cool space.
Really cool.
These are the unit types in Houston. They're going to be a little bit more funky shape with all that paneling and things. The little blue areas here are the windows, and a couple of these have big long windows. There are some that don't have any windows, so you can keep it for those interior units. But that's pretty cool. Their unit size are somewhere 450 square feet to 2,000 square feet, depending on what you want. So first level, how that's going to look, you can see there's some interior units here. You can drive right in off the street, off the parking lot. Level 2, what they've done on this facility is they put in 2 car lifts, one on either side of the hallway. And so you car lift up to the second and third levels with your car, and they're going to keep 3 lanes here, 3 car lanes, so you can drive on either side and then have the passing lane basically in the middle. And you can see how these units all come together. And pretty
Very
much
nice.
the same thing on the third level, just another level with the same thing. Again, the car lift goes up to those. And then the fourth level is where the lounge area is. And this is going to be walking human area only, no cars on the fourth level. And so again, the units are here, different shapes and sizes.
Good stuff.
The
Paul,
location,
are these
yeah,
units air conditioned, and I'm assuming also they have heat as well?
they're all fully air conditioned. In Houston, they're toying with the idea of having some of the hallways open and have each unit air conditioned. In Austin, the whole facility is enclosed and air conditioned and heated, and that way. So,
Okay.
and of course, the other nice thing is they have full level modern security to the whole building. You can only get in with your code or your fob. So it's a pretty secure place. People are there working or doing whatever 24/7. So that's good as well. The other thing that we planned is that this location probably couldn't be better in Houston. It's in the Houston Design District, and it is a few miles from the downtown, a few more miles to the airport, and they are looking at maybe some pickleball courts on the top on the roof. But as to your point, Trevor, it's fully air conditioned and ventilated. You drive up access to all your units except that 4th floor. This by happenstance or design, right across the street from here is the Aston Martin car dealership. And so, as you can imagine, there's a lot of car enthusiasts who love this space, and they bring in their cars or store their cars. Sorry, that's my dog. store their cars and that sort of thing. So that's great. The other thing that XSpace company has done is they have written a contract with the NASCAR organization to put up some facilities at NASCAR tracks. And so you can imagine all the car guys they're enthusiasts that would have their cars at a track and kind of show that off and have their man caves there.
Really cool. Really cool. I mean, it being next to an Aston Martin dealership, that speaks volumes, right, about the location.
Again, that Houston location, we love it. It's right there. The project itself, so besides being a great facility, all of that, great location, all of that, the returns are some of the best returns that we have structured in quite some time. We're looking at an internal rate of return of 22%, almost 23%. The other nice thing about this is, speaking of the diversification, is it's only over 2 to 2.5 years. So your money is not held up for the 5-year traditional like we have in multifamily. So, and a 1.5 multiple over that 2 years, 2.5 years is very good. We're giving a 7% preferred return. And then after that 22% IRR is achieved, it goes to a 50-50 split from there. This slide says that we are accepting 100,000 minimum, but actually we are going to 50,000, I think, for several select groups. And so Maria is chiming about that. So if you were to invest, 100,000 in year one, basically by a little over at year two, you would be receiving 49,500. Your total return 149.5, which equates to the IRR of 22.8. Your cash on cash is 10%. Annualized return is almost 25%, and your exit year, your multiple is 1.5. So excellent returns on this product as well. And some of the people ask me that why that is, and part of the reason is the build is really fairly simple. Obviously, those panels on the outside are really cool, and those will get put up, but you're basically building a parking garage. And so you're not outfitting each of the units. You're not putting in kitchens and bathrooms and all that like you would for multifamily. So the structure is fairly simple. The tenant then comes in and puts in the bathroom and kitchen if they want, or whatever they want to do in there. So it makes it pretty straightforward, pretty easy to build. It's a quick build over, I think the build is going to be over about 14 months. And it's a quick return on your money.
Beautiful.
And that's kind of the basic brief presentation. This is a picture of XSpace Austin, where I personally have a couple of units, and this is the lounge up on top on the 4th floor. And again, it overlooks Lake Travis. We'd like to invite you all to an open house. If you can make it to Austin next Tuesday, we're having an open house so everybody can see XSpace Austin, and we'll talk about XSpace Houston. And you can got to get a tour and see it for yourself and see what people are doing in their units and how the space is used.
Well, how does the Austin facility size-wise compare to the one that's going to be built in Houston?
Good question. So in Austin, there are 106 units. They have less than, they just, did this. I think we completed and got into our unit late last year. And so they have less than 10 available now. So they almost sold out. In Houston, it's going to be 88 units.
Okay.
And it's just the way it was configured and how it all came together.
Okay.
So
Fred asked a good question. Hey, Fred, why don't we just unmute you? Let's unmute you, and you can ask your question directly to Paul. Let's do that here.
Hey, great. Hey, Paul, this is a pretty wild concept, to tell you the truth. I think it's pretty neat. Obviously, it caters to a higher earner, if you will, somebody with a little bit more money, right? But really the question I was wondering is, you said the whole time was 2.5 years. Then you just mentioned that the project is going to take about 14 months to build. So what is the true hold time for an investor, an LP? Is it 2.5 years plus 14 months, or?
No, that's all included in there. So that's just the build time. So no, your investment will be right at 2 to 2.5 years, again, depending on how that's built. But your money will only be tied up for that time, for that 2 years, 2.5.
All right. So basically, I think what you're saying is roughly a little over a year and a half to build, and then you're going to hold it for a year or so to get it stabilized, and then you're going to turn and sell.
Yeah. So, we are selling units. So these are condos. People buy these units.
Condos.
Yes. So they're
I
buying
missed that. Thank you.
Yep. They're buying their units. So you think of a townhome project that you're for sale and you're selling them off, right? And so people buy them to rent them then subsequently, but they are to sell. And I will tell you that right now there are right about 17, I was just told the other day, 17 to 18% already pre-sold. And
You're talking about what, in Houston?
In
For
Houston.
the Houston development?
Yep.
That's pretty cool.
And so we think by summer here, by July-ish, or by the time we start digging, our goal is to have 25% of the units sold.
What, if you don't mind me asking, what is the price, the range?
So the ones in Houston, we got in a little early, and so our price was lower. They get higher. And so right now, the contracts that they're writing in Houston are right at about $500 a square foot. They've got a couple, I've got a couple of units that they've sold actually for $600 a square foot. Their pro forma shows that they believe the price escalation will go about 5% per month, what they're projecting.
Paul, I have a question. So I'm just trying to understand the phases of the transactions here. So you guys are looking for investors, right? And then whatever that equity amount is. And then once it's built after 14 months, then you already have some people that have already raised their hand, right? Say, I want to buy one, right? But then I guess is it after the build that the condos actually start being sold, like pen gets put to paper and like the money gets, no? That can happen beforehand?
17 to 18% have already got contracts, are already pre-sold.
Okay.
So they're selling before they're finished building.
Okay. And so as far as the exit is concerned, like after the 2.5 years where investors will get their money back plus the returns, are you guys is that like when we hit X amount of percent of the units sold, then boom, we distribute the capital back in the returns?
Yeah, you're familiar with multifamily, where they say once the property is, when you're developing, when you're building multifamily, they typically say once you have stabilized the property, which usually means 90% has been rented. In this case, it's fairly similar. Once about 90% have been sold, the property is then stabilized, and then distributions will go from there.
Okay.
And a quick thing, what can be better, by the way, than two Trevors on the same Zoom? But one of the things, so what happens is I want to make sure we're clear too. So the PSC and Massive have joined with XSpace. XSpace is an operator of these spaces. So we've partnered with them to help raise some money, to help get the project up and going. We purchased the land and brought it to the deal, different things. And then once it reached this stabilization period, our investors in our team get bought out, and XSpace stays on as an operator of the space. So for us, of course, we do a good job and we have a good deal. We want to do many deals with XSpace. And so because we believe strongly in this asset class, this is unique, this is a different type of investment. And so we will move on, and XSpace stays as an operator. It's run almost like a condominium complex where there's like a homeowners that takes care of the common area costs and insurance. So it's a very different model. And what's also very different is we don't finish the units. They get an empty space. And then the owners have to pay, just like Paul said, he's going broke because his wife and daughter are spending all his money. We did a tour of it last week, and I mean, there's a guy who's got like a simulated golfing range inside of his unit and hangs out there with his buddies, and it's bizarre. So again, this is not grandma storage, right? This is eclectic, high-end people that are looking for a combination of industrial, office, and storage, and a WeWork. So the third floor or the fourth floor also has areas like we were there, and there was a young man using the conference center, and he was doing a meeting and had the screen hooked up. And so there's like a WeWork environment on the upper areas that can be used as well. So it's a pretty, like, very few things incorporate so many things. And the fact that it is a high level, right? You got to think we sell 88 of these in a population of 12 million people in Houston. It's pretty interesting.
Absolutely. Absolutely.
And we did mention it earlier, but I just want to make sure, because we're big friends with the Freedom Chasers, and so we know that we said for that particular group, all you have to say is I am part of that group, and the minimum is reduced, because what we wanted to do, this is not normal, right? This is a different type of asset class. We wanted to come and talk about diversification. Just for example, I'm diversified. I've invested in Paul's Medical Center. We knew each other before these deals, and I'm a passive investor in his medical center because I try to diversify my real estate investing, even though multifamily is still my first love and most of my investments. It's really good to stagger timelines, asset classes, and locations.
Very good. Thank you, K. Trevor. And if anybody else has any other questions, just feel free to raise your hand and unmute yourself. I have a couple of questions, Paul, that I wanted to send over your way. So the first one is this. WeWork. I know people have mixed opinions on that, especially how it's played out, of a WeWork-ish space. So what would you speak to that point when somebody has concerns like, well, this is just another repackaged WeWork, kind of development?
I don't know if anybody has ever used WeWork. We did for a while in Austin. We used WeWork for our office, and it's a phenomenal concept. It's great. We met a lot of people there. You get coffee with people, you eat or something, and you start talking to people. The problem with WeWork, of course, was the owner, and he took off with a bunch of money. So but other than that, it worked well with that. But that was all office space, true office space. And I guess you could kind of do what you wanted to in there, but it was all traditional office. This space is flexible space. So you don't have to just put office, you can put other things in there. And again, like WeWork, though, you come out of your office. We keep our garage doors completely open, and we walk around and talk to people, and it creates that community vibe, and that's what's really cool about it. WeWork was just office, downtown, urban office. These spaces are not downtown urban. They're more in the submarkets where people live, and they do that. So, and then also, of course, these units are big enough to put cars in. One of the guys just down the street or down the hallway from me has 6 Porsches in there. He's got them all in there, and we all go look at them and touch them once in a while. But but a nice guy, fun guy. And actually, that guy is from San Francisco. He doesn't live in Austin, but he stores his cars here at X-Space because he said storing them here in Austin was much cheaper than he would have been in San Francisco. And so again, cool. People are from all over, and fun to talk to them.
Excellent. And the next question I wanted to ask was, so this is a development deal. And
Correct.
I know some people with, the recession, some people say the recession's here, some people say we're on the cusp of a recession, and then they get a little bit of stage fright when they see a development deal in light of where the market's at right now. What would you say to that concern, as it regards to this X-based development, just to help people understand a little bit more about it and how this is how this type of development is hedged against risk in light of where we're at in the market?
Right. I'm so glad you asked that question because I do like development. As I told you in the beginning, we started out with, single family homes, some lake lots, some multifamily and things. And what we've evolved to with our company is mostly development. And the thing about development is it takes a little while. So how long does the typical recession last? The typical recession may last 6 months to maybe at the most 2 years and a deeper recession. So how long do development projects take? They take a couple of years. In fact, our Georgetown development project, it's going to take us a full year, 12, 14 months, actually maybe a little 16 months to just do entitlements, due diligence, permitting, all of that design. And then we go to the vertical, the vertical development, and then eventually build in the horizontal. So there's basically 3 phases of some of those developments. That spans over the time of a typical recession. So if we start correctly and a recession comes, sure, it's going to come and go and we can't predict it and all that. But typically we will be out of that recession when these units are ready to be bought.
Makes perfect sense. Thank you.
And the clientele who's buying these are those folks that aren't near as much affected, right? I mean, if you're parking 6 Porsches in your garage and you live in California, again, doesn't mean that you can be foolish, but this is unique, right? This is high-end industrial work storage space and again, when you think of it, city of 12 million people and 88 units to sell, it's not like we built an apartment complex and there's 10,000 doors in the neighborhood.
But again,
absolutely,
to your point, Trevor Walker, that development is like that. And that's one of the reasons I like development, because typically we can dance around these recession cycles and these downturns with our development. We can extend it a little bit, this and that, and we can kind of try to follow it that way. Whereas in a typical, if you go in buy a multifamily, you've got it right now in the current business cycle. So what are you going to do with it? When do you buy? When do you sell? And just like I said, my other company, we have been selling this last year just because people are buying. And so in development, it's a little different. It extends that time period in any development, not just this one, where we kind of dance around that recession and typically can be on either side of it.
Very cool. Thank you. Well, we're coming up on our last. What's going on?
There's a good question. There's a great question in the chat, and I want you guys to answer this. Trevor and Paul. So in multifamily, we look at rent. This is from Fred. In multifamily, we look at the rent growth, the gross income. We're looking at job growth, and we're looking at how the asset's going to perform. Can you talk about why that's so different with this one, and how we're not going to be property managers on this? We're not going to be looking at this after it's built. Can you talk about why it's so different?
Well, this is not too different for me because we've done a lot of development. So, we've had, with my company, we've had single family home developments and things like that. So you are selling each unit as you go. Typically, when you do that kind of a development, you don't really make your bigger money until the end, when you've sold those last few units or so, or the last 10, 20, whatever the number is. So up front, you sell a unit, you pay off some debt. You sell a unit, pay off some debt. And then at the end, it's kind of a bigger pot of money. And that's just the nature of development. And that's how that works. I like it. Development, I hate to but development typically has a higher returns than other kinds of real estate. But that's the nature of development. I feel like we can control it. At the end of the project, you have a new facility. There's not a lot of maintenance, of course, at that point, right? And you've sold them all off, and therefore you turn it over to the HOA and you walk away and you go do your next development. And all of the investors have gotten their money, and usually it's a higher return with development. And I like the control aspect of it.
Yeah, I
So-
totally agree. And yeah, Trevor, go ahead.
Yeah, so one of the things I want to talk a little bit about, in multifamily and syndication, we talk about liking, and trusting somebody, right? And that's who you're going to give your money with and you're going to do. Okay, think about this. Paul was one of the first tenants of X-Space Austin, which was the first build of this Australian company in the United States. And he went, this is the coolest thing. How do I take it to the next level? And how do I help others reach financial independence for coming along this journey? Okay, so again, he's drinking the Kool-Aid. He's a tenant. He's there. He's connected. He's made a relationship with the owners of X-Space and said, hey, how do we join up and be part of this whole new thing that's going to happen in America? And there are other companies doing similar things, not to this scale. And so I just want to, it's because this is so weird, right? This is so different. But the fact that, Paul is there. In fact, you bought a second unit, didn't you, Paul, after you were there?
Yeah, so we kind of did a little different thing. I don't know if this was my daughter Lacey's fault or my wife's fault or whatever, but when we went in early on, we saw these units, and I said, kind of like those with the windows, and somehow or other, whose ever idea it was, we bought 2 units together, and we took the wall down between them. And then, so Byron tells me later on that people were walking by and go, that's a cool idea. And then we put a mezzanine up, and so all of a sudden, a bunch of people are taking their walls down in between, and they're making them even bigger. So that was kind of fun thing with that. I do want to Trevor's point, there are multiple owners in X-Space Austin that are buying units in X-Space Houston to rent them out. So I think, again, that's a testament to they like what they see, they like what their experience, things are going well. Their returns have been very good, and now they're going to become owners to rent out in Houston. So they're drinking the Kool-Aid too, I guess, but they like what they see and like what they're experiencing.
Fantastic. I appreciate you bringing up that point, hey Trevor. Dr. Paul here is living X-Space in every way, shape, or form. So it's good to have somebody in the driver's seat right on this investment that's living and breathing X-Space.
Yeah. So
very good.
I want to make sure that we say thank you so much to the Freedom Chaser guys. You guys are awesome partners with Massive Capital. We, other than 2 Trevors in the same room, when sometimes I ask him a question and I answer, and nobody didn't want to hear it from me, but we want to thank you guys for letting us do this. We hope that people got value out of a different approach at looking at real estate investing and a unique thing. Again, our goal, and I know your goal, is to educate people so that they can create financial freedom. So we really hope that your audience got that tonight, and we appreciate your time and letting us share your stage.
Absolutely. Thank you, K. Trevor. And just FYI, Fred here asked a question, how do we get details for the documents to invest? Maria, I guess you dropped in the link there.
I did. That's a link
Thank
to our
you.
drive. It does have a lot of links on there, but you can schedule a call and we can talk more about this deal. If you're ready and you want to look really closely to the paperwork, this QR code does take you to that. So if you want to do that now, but I would definitely want to set up a call and get you going on that. But let us know how we can help. It is something different. It's something that, we talk about multifamily, we talk about calls with Trevor and the Freedom Chasers. I mean, we talk about multifamily. This is something different. So I'd love to chat with you guys and really figure out if this is something that you want to invest in. So please take advantage of that link and let me know if there's any way that we can help or explain this even more. We'd love to work with you, and we'd love to do more.
Thank you, Maria. Do you have a direct link that you could drop in the chat where somebody could book a call with you? Or should
Yes,
they
I
just
do.
scan the QR code? Yeah, just go ahead. There you go. Yes, just go ahead and drop that in the chat. And also, just so everybody knows, we do post our Zooms on our YouTube page. So this recording will be available to view in the future. And yeah, Dr. Paul, we appreciate you joining us tonight. It was great to have you on as our special Zoom. And of course, Maria, always great to see you. Kay, Trevor, always great to see you. And I miss you guys, man. We used to see each other more often, but well, hopefully we can fix that in the future. But again, everybody else who joined us tonight also, thank you so much for taking the time out to come hang out with the Freedom Chasers and with Massive Capital. Hopefully you learned a thing or two about diversifying your investments, and stay tuned for future announcements on our next Zoom coming up. So did I miss anything, Dr. Paul? Any last words, or is that a wrap?
Nope, just the power of diversification for your portfolio. This is what the message is tonight. And I just wish you all the best with your endeavors with real estate.
Thank you so much. All right, ladies and
Trevor.
gentlemen, we appreciate y'all so much. Y'all have a good evening, and we will see you later.
Thank you.
Thank you.
I think we're good. Take care. Thanks. Thanks, Victor.